Hello and welcome to Class 8 Personal Finance, and congratulations on your championship, Max Verstappen. Yeah, I just ran out of this can because I've been troubleshooting this computer for like an hour and a half, and it's really frustrating, but I finally think I've got everything working to do a recording session. This video is about historical drawdowns, but before I do that, I want to put out an update concerning GuideStone because after I wrote my, recorded my Christian ESG video, I also emailed GuideStone to kind of ask them the hard questions, and they actually gave me a reply, kind of a form letter reply, and not something from their investment committee, but I wanted to at least put it out there. Let me shorten that a little bit. So I've got to have my audio meter right here. And it says, Dear Mr. O'Hara, thank you for contacting us and providing this feedback. We have sent the information to our investment management team to review. For more information on our investing philosophy, please read below. I probably should have taken the GuideStone word search off the email before I took the screenshot. Nonetheless, we are in sympathy with those who have concerns related to investing in certain companies. We apply our strong Christian beliefs across a diversified set of mutual fund investments through rigorous research. We have developed an investment approach that we believe best balances our fundamental Christian beliefs with the realities of investing in a fallen world. To that extent, our faith-based investing policy is as follows. GuideStone does not invest in any company that is publicly recognized as determined by GuideStone Financial Resources as being in the alcohol, tobacco, gambling, pornography, or abortion industries. You still have Netflix, guys. Or any company whose products, services, or activities are publicly recognized as being incompatible with the moral and ethical posture of GuideStone. And I will admit, the communist Chinese government is not a company. I'll admit that, but you got to realize it's probably publicly recognized as being incompatible with the moral and ethical posture of GuideStone. I mean, unless it isn't. Because GuideStone's part of the Southern Baptist Convention. I've heard it said the moral and ethical posture of the Southern Baptist Convention, or words to that effect. In administering this policy, GuideStone has placed almost 700 companies on our restricted list in which we do not invest. We don't have that list. I might ask for it. When I went through the S&P 500, which isn't even 700 companies long, I found very, very few. The Committee on Faith-Based Investing, an internal committee, determines which companies violate GuideStone's faith-based investing policy. I'll be interested in seeing what this list of 700 companies is. This next paragraph goes into fiduciary standards. GuideStone is held to a different standard as to how it invests participants' dollars. As fiduciaries, we're subject to legal standards applied to fiduciaries. This involves the prudent man rule. The fiduciary is legally required to act prudently in the economic interest of those it serves. Then why do you charge such high fees and do a poor job with management, as I established in the previous video? We seek to maintain moral integrity in what we do. As mentioned above, almost 700 companies are on a restricted list. At the same time, we are very conscientious to avoid potential litigation issues that could arise in the retirement fund industry, like mismanaging your funds, which I established that you do. Consistent with the Southern Baptist Convention Constitution, GuideStone will not follow a course of action that might cause it to be in violation of Texas or federal law. Well, making poor investment decisions might not be in violation because you can just say, well, we were trying. But yeah, I went through that in the previous video enough, and I'm 4 minutes into this. So it is virtually impossible for anyone to function in our society today without carrying on relationships with businesses that profit from endeavors and relationships one might find objectionable. This is true. In these relationships, investors inevitably provide financial support to companies or person whose product, service, or conduct might be morally repugnant to most Southern Baptists. This is why we have determined that our filter must be designated to exclude companies publicly known for practices contrary to our worldview, like Netflix. So if you're confused about this, go back to my Christian ESG video on this channel, and I put some more detail in there. But this is a profoundly unsatisfying response. And one, I was kind of sitting on it. And two, I thought maybe the investment committee would get back to me. Oh, sorry, the investment management team. They they sent it to the investment management team to review, and I thought that they would potentially get back to me, so I wanted to give them some time, but at a time. So they're going to get a response from me at some point, and we'll go from there. So that's the update on GuideStone. Let's talk about historical drawdowns. If you're like a lot of investors right now, you're down about 25% here in 2022. I'm recording this on October 10th. I should be publishing the video sometime this morning. Down 25% is shocking a lot of folks, scaring a lot of folks. I don't know anyone personally who's like pulled everything out of the market, but it's caused some folks to be pretty nervous. Let's talk about historical drawdowns and what asset allocations do to these drawdowns and how you might construct your asset allocation better in accordance with your risk tolerance. So we'll have some things to think about here. This is Portfolio Visualizer. I've shown it plenty of times here on this channel, but it's going to be the primary tool I use to go through this. My settings in Portfolio Visualizer today. We're going to keep the start year at 1972. That's as far back as the data go here. I'm actually going to switch this to month to month. I don't know why this says year to year here. We're starting with $10,000. That's just the default. And I've got 3 portfolios here. And because not all of these data sets for these asset classes go back to 1972, I'm picking 2 asset classes that actually do go back all the way with the data that Portfolio Visualizer has. Grammar. The data that Portfolio Visualizer has. See, data is plural, but it's the object. Never mind. So we have the U.S. stock market here with 100%, 90%, 80%. And on the next page, I'm going to have the 70, 60, 50 right here. I better switch that to month to month and redo it all. So let's do that. Month to month, etc. We're going to recalculate this, make sure we got everything there. I guess it already was. I don't know. Yeah. Month-to-date results for the current month are not available under the free tier. Yeah. I don't pay for Portfolio Visualizer. I don't think most people really need to. But let's check this out. So first off, we're going to talk about what were the results. You need to kind of keep this in the back of your mind when you think about these drawdowns, because it's not so much the drawdowns that you need to worry about as much as the final result, but you also don't want a drawdown late in your investing life. That's the thing. So, but you do need to think about what you're potentially giving up by avoiding these drawdowns, because if you had started in 1972, I think this is January. Yeah, January 1972 with $10,000 in 100% U.S. stocks, you would have had a final balance of $1.3 million, which is pretty nice. That's not continuous contributions. That's just a lump $10,000 just sitting there and growing over time, and that's pretty nice. 90% U.S. stocks with 10% intermediate term treasury bonds. That's not even total U.S. bond market, just treasury bonds. Still made $1.2 million. 80% U.S. stocks made $1.1 million, which is pretty good. But you can also see the maximum drawdowns here. With a 100% U.S. stock portfolio, the maximum drawdown period was about 51%. And that occurred between November 2007 to February 2009. That was the global financial crisis. And by adding 10% stock, adding 10% bonds here and having 90% U.S. stocks, this hypothetical investor basically reduced that drawdown by, let's call it 5%. So it was a 45.5% drawdown during that same period. And for the 80% stocks investor, that drawdown was about 40%. So about 5% for each 10% in intermediate term treasury bonds. Let's take a look at more of these drawdowns, though. In Portfolio Visualizer, you can get this tab right here. By the way, I'm in the backtest asset class allocation tab. Going on to drawdowns here, and this little graph here is pretty helpful because it basically removes all of the gains and just focuses on the drawdowns. Because if you're worried about crashes, this is a better thing. It's not a better thing to look at, but it is a thing to look at that's helpful. So you can see that there was a crash right here back in late 1974, oil crisis. Am I right? Yeah, oil crisis right there. 1987 here. We had some stuff going on. I think it was Russian bonds, Russian debt. No, that was 1998. Black Monday period, according to this, was in 1987. That makes sense. And then there's another thing going on right here in 1990, right here. Here's a nasty one. The tech crash, .com boom. In 2002 here, U.S. stocks lost 44.11% right there. And then we had the global financial crisis, which actually was worse, where you had, I saw 50.89 right there, more than 50% of a loss back in 2009, and it took a good while to recover. I had some trouble in Portfolio Visualizer making these numbers in this table makes sense because it shows you the names of the stress periods, which is nice. You got the subprime crisis, the .com crash, the start of the COVID-19 pandemic, etc. But these numbers just seem off. We just talked about the oil crisis being in the 1970s, and this thing's showing us 12.61%. Well, this isn't 12.61%. This is 45% right there. So for now, I'm just going to say ignore the historical market table right here. But you still look at this area of drawdowns for 100% U.S. stocks, and you can see that maximum drawdown we were talking about earlier, the 50.89%, happening between November 2007 and February 2009. That was the global financial crisis / the subprime mortgage crisis. So that length of drawdowns, 1 year and 4 months, and then it took until March 2012 before it recovered to the previous point. So that kind of drawdown basically leads to that rule of thumb that you should not have more than twice the amount in stocks that you're willing to lose. So let's say that you're not willing to lose more than 30% of your portfolio in a crash, then you shouldn't be any more than 60% stocks, something like that. But we'll talk about that a little bit more in terms of goals. If having too small of a stock allocation is going to impact your goals, then you need to think about either rethinking your risk tolerance or increasing what you're contributing so that you can actually expect enough when you're actually hitting that retirement goal. When you go down to 90% stocks, we talked about this maximum drawdown here being 45.5%, call it 45. Also, global financial crisis being the worst one. And for 80% stocks, 40% also the same period of time. These can switch around depending on what kind of settings you put in here with different asset classes, etc. So forgive me for sounding redundant there, but that really was the worst one since 1972 on these statistics. And take a note here. We have in each of these January 22 through September 2022, and I'm pretty sure we'll have some sort of semi-official name by the time we're at the end of this. But right now, our current drawdown is about 25%, and so we've got a nice little ranking right here. We are officially worse than the start of the COVID-19 pandemic in terms of drawdown. So hopefully, if you were invested at that point, you had a little bit of a litmus test as to what you were willing to take on in a crash, and you were better prepared for this one. I think the best way to assess your risk tolerance is to go through a crash rather than answer a survey question that kind of goes, rate your risk tolerance from a scale of 0 to 10. That doesn't mean anything, right? How are you supposed to quantify that into what you're, willing to lose? Let's go through even smaller quantities of stocks right here. So I've got a 70% US stock portfolio, 60%, and 50%. And so you can see these final balances right here. And let's actually go back and see the final balances on the 100, 90, and 80. So keep these in mind. Each of these exceeded $1 million at the end date. And again, we're starting in 1972 with $10,000 and no contributions. It's just $10,000 sitting there growing and compounding. A 70% portfolio did not reach $1 million, and a 50% portfolio reached about $700,000. So it's not merely a matter of, okay, how much more money are you going to have at the end? It's also, hey, does $700,000 meet your goal? And if it does, then maybe you want to have that lower amount of risk because you don't want to take those drawdowns. These are personal questions that you have to answer on your end, and they're not going to be as simple as just looking at the numbers. Not as simple as the numbers I'm showing you, but hopefully you get the idea. You're going to have to figure out what you expect out of your portfolio based on how much you're putting in stock and bond. Let's look at these drawdowns here. The maximum drawdown for a 70% portfolio was 34%. For a 60% portfolio, it was 28%. And for a 50% portfolio, it was still 22%. If you're shocked by a 22% drawdown and you feel like this is the end of the world, then you might need to rethink your risk tolerance or kind of how you approach things with investment, because that's a pretty low drawdown. So if this is like the worst you could possibly handle, maybe rethink things, or maybe you really do just need a safer asset allocation because you're going to engage in bad behavior and pull your money out, etc. This is the part where an advisor would come in and say, hey, pay me, however much, and I'll help you not pull money out and kind of coach you through this kind of thing. I have a video on advisors. It's actually the previous one to this one, if you want to look through that. Let's look at the details of these drawdowns here. So you can see this, it's still the same periods of time. You can still see that the global financial crisis really sticks out there in the 2008-2009 timeframe. Let's take a look at the details here. 2007 to 2009 is still the worst for all of these, 34% for the 70% portfolio. Do we have any deviations? We actually do. Like I was saying, so for 50% US stocks, I think this was the oil crisis, 1973 to September 1974. Am I getting this right? Yeah, so it calls this the oil crisis, but I think the dates on these portfolio visualizer may need to change. But January 1973 to September 1974 was a 22.24% drawdown for a 50% US stock portfolio. And even now, even with a 50% stock US portfolio, you would be down 18%. Now, why is that? It's because interest rates are going up. Remember, the bonds can actually move around too. And this is an issue that you might bring up if you know what you're talking about with bonds, because I'm only talking about intermediate term treasury bonds here. Now, remember how bond pricing works when interest rates go up or down. Let's say I bought a 6% bond from Microsoft yesterday. And okay, here's my bond. It's a trucker red tag, but that's okay. So this is a 6% bond that I just bought. And tomorrow, Jay Powell wakes up and says, hey, we're going to raise the rates by more than 75 basis points. We're going to raise them 200 basis points. We really got to, jack up these interest rates. And so now these companies are selling 8% bonds, and I'm holding 6% bond. this thing suddenly is worth less because people want to go buy the 8% bond instead of this 6% bond. And if I want to sell the 6% bond on the secondary market, then I'm going to have to sell it for a lower price. So in fact, the value of this bond, even though it is a bond, can go down based on the interest rates in the secondary market being different than what I got this for. That's what's going on with that. So in this market, bond prices have gone down because interest rates have gone up. So bonds aren't like necessarily the perfect hedge in a rising interest rate environment. They can be a great hedge in a falling interest rate environment, which is what we've had since 2008 up until 5 minutes ago, basically. And they can be good when people are insecure about stocks because people rush to safety in bonds. It's just that in this particular case, the bonds haven't done well because of those rising interest rates. Let's go to the next one. This is going to be a more limited period of time because I'm going to add global stocks here. This is global ex-US, so excluding the US stock market. And I'm making this about 40%. So about global weight, it's not going to be perfect because I don't know what these weights were in 1987 when this data set starts. And then I'm going to add total US bond market right here. And that'll give us the advantage of having corporate bonds in there in addition to treasury bonds. But these are 100%, 90%, and 80% stock portfolios in global stocks. And they do go up to September 2022 right here. So don't feel like, oh, global stocks, it only went up to $161,000. That's less than the $1 million you had in the other one. Well, we're talking about a more limited time frame. We're talking about starting in 1987. So don't get that impression. Nonetheless, we can see the maximum drawdowns here, even with global diversification, 54.03% maximum drawdown in the 100% portfolio. If you go down to the 80% portfolio, the maximum drawdown goes down to 44%. And you can look at the drawdowns here and find, again, the global financial crisis is kind of that nice litmus test going down to that 54% right there. And if you look at the 100% one, so if you add global stocks and you go to 1987 as the start of your data set, right now the current drawdown is the third worst. Oh, by the way, I was born in 1985, so this is basically the third worst it's been since I've been born, which is pretty interesting to think about. The second worst was the dot-com crash at 44.71%. If we go down to 80% stocks, again, it was only a 44% drawdown, which is less than the other one. It's less than that 54%, right? And even so, this drawdown with bonds not having done so hot is still 23.48% as compared to 25.69%. It's just not much of a comfort this time. Let's look at the next one, because the next one is 70, 60, and 50% global stocks, basically the same formulation. And we can see, let me go to drawdowns here. Global financial crisis still wins, but it's 38.63% for a 70% portfolio, and then all the way down to a 27.17% for a 50% portfolio. And note, the way bonds have done this year, this is just a special thing. This is a special period of time where bonds haven't done well. This, for a 50-50 portfolio, this is the second worst ever since 1987. That just is what it is. The bonds aren't perfect. They're really not. So what should you take out of this? It's really that rule of thumb that you shouldn't have more than twice in stocks than you're willing to lose. That's really the bottom line. and also make sure that you understand what's going on in the bond portfolio. If you have the ability to diversify your bond portfolio, you can come to understand it. Maybe you can add some more short-term bonds in there if you're really sensitive about that. The issue is that that would have been really good advice to have back in 2021 before all this started. And now, I mean, the drawdowns already happened, so that might not be something you want to mess with. Um, Definitely don't try to time the market, but if you're sensitive to bonds going down like that, let's say you're close to retirement or in retirement, then you might want to consider adding some shorter term bonds in addition to a total US bond market index fund. For example, go like half short term corporate bonds and half total US bond market, something like that. Um, One other thing I want to show in this context is something a little fun, a little even more nerdy than where I'm going here. And this is the efficient frontier calculator in Portfolio Visualizer. So suppose I have just 4 asset classes here. I've got large cap value, small cap value, US stock market, and the intermediate term treasuries that we had earlier. What would be the most efficient way if we started in 1972 and we had magic forward vision to figure out what's the most efficient way? Like, how can we maximize the return and minimize the volatility, minimize the up and down? Oddly enough, this is the weird portfolio. It would be to be in 34% small cap value stocks and 66% intermediate term treasuries, which is really interesting. So, because it gave us a 90.11% expected return with only a 7.49% standard deviation. And here's the way that looks on a graph, and I'll explain this. Can I make this a little smaller? There we go. That's visible. So let me get my face out of the way for a moment here. Turn off the camera. There we go. Does that look okay? I guess it does. Hopefully you don't see an ugly blue outline right there. But you can see US small cap value stocks had a volatility of 18.35% and a return of 14.29% over time. And intermediate term treasuries were down here. They only made 6.41%. Their standard deviation was 5.79%. But if you combined them, then you have this nice, perfect little point of efficiency. It's tangent to the line that says this is the most efficient way. And then you could have said, hey, I'm only willing to take so much standard deviation, so I'll do this. And you could have had, closer to a 50-50 portfolio, something like that. And oh, by the way, the US stock market, it had, all this volatility right here, but this is huge gap to the return of a small cap value portfolio with the same return, but it also had 15% treasuries right there. Okay, that's a little nerdy. You might need a few minutes to kind of think about it and figure out what all this actually means. Let me show you one more thing to kind of put this together in your head. And that is with a back test. So I've got 3 portfolios here. I've got 34%. I messed that number up. Let's just update that in the system. So I've got 34% small cap value with 66% intermediate term treasury bonds. I've got a second one that is, I tried to optimize this, basically make this the same amount of return as the US stock market portfolio. So 46% US small cap value and 54% intermediate term treasuries. And in this third one, I have 100% US stock market. So let's look at these numbers here. For one, having 46% in US small cap value yielded about the same return as being 100% stocks, 0% bonds. If you had just been in total US stock market, starting with $10,000, you would have made $1.3 million. If you had done 46% small cap value stocks and 54% intermediate term treasuries, you would have had $1.3 million. I think the difference right here just isn't all that significant. But note the difference in standard deviation. The standard deviation here is only 9.13%. The standard deviation here, 15.74%. That's a huge difference. The maximum drawdown on the small cap value portfolio was 21%, but it made the same return as a portfolio with a maximum drawdown of 51%. And you can check out this line right here. Note the orange line is 100% US stock market, and you can see it flowing up and down, up and down. I mean, it still gets there over time. Whoever, put that $10,000 in and fell asleep and woke up has $1.3 million still. But the small cap value portfolio smoothed out a whole lot of bump. What should you do about this? I am not saying just go 50% small cap value, 50% treasuries and call it a day. Not necessarily, because we don't know how much of an effect these factors will have in the future necessarily. But it does say if you have an ability or an interest to diversify into factors like small cap value, there's the benefit right there. One, it can increase your returns. If I were to make this, for example, let me retain this 46% small cap value, and I'm just going to call this 100%. Small cap value. And I'm going to mess with portfolio 1 here. I'm going to make this 100 and 0. Let's see what happens. That Red Bull is starting to come out of my throat. Not the puke kind, just a gas. So if you had done 100% US small cap value, I mean, that's a pretty nice return. $5.7 million. That's pretty nice. Is it guaranteed to be that level of return in the future? No. But what I'm saying is this red line, I think, behooves us to at least consider a tilt to small cap value, and having that kind of tilt could enable you to have more bonds in the portfolio than you would otherwise have. In other words, it could be a way of bringing up return without necessarily bringing up volatility, because you will have increased your bond allocation. Okay, if you want, what I'm not saying is that small cap value has less volatility. Note the standard deviation here is 18.35%. It's more volatility, absolutely. What I am saying is if you tilt a little bit to small cap value and at the same time increase your bond allocation, then you could be, if the factors work, you could be increasing your return and also bringing your standard deviation down or keeping it the same if you increase your bond allocation. That's what I'm saying. So consider the factor tilting. There is a factor tilting video on this channel. But the big thing to take away from this is going back here with a 100% US stock portfolio. And let's just say a 100% stock portfolio, expect a 50% drawdown at some point. It may not happen. Hopefully it doesn't happen. But we're in a 25% drawdown right now. And let's go to this drawdown here with 40% international stocks. Same global financial crisis. The drawdown was 54%. So be careful out there when you're making your asset allocation, and don't set yourself up for panic. And also consider what you're going to do to your bond portfolio, and consider potentially a factor tilt if you have the know-how to do that, if you can figure out the complexity of that. Do the algorithm things, liking and subscribing to the channel and leaving a comment, etc., if you feel like doing so. See you in the next video.